Hi, Nasdaq followers. I'm Danielle Rutsky, ETF Lead Product Manager, here at MarketSite in Times Square with Jeff Weniger, Head of Equity Strategy of WisdomTree. Thank you for being here.
My pleasure.
So why should investors consider the WisdomTree U.S. Quality Dividend Growth Fund in their portfolio?
Sure, and that fund has been around since May of 2013 at this point, so it's becoming one of our more seasoned funds. It's almost as new as some of the other ones that had been launched almost 20 years ago. It's a 10 plus year track record, and it's been doing great. And you know, one of the things about it is I think it's really starting to earn its claim to fame on downside capture, which in these markets in 2025 is starting to become much more relevant in conversations, and it's really earned its stripes through the years with the COVID crash, the 2022 bear, and so on.
So with that history, what benefits does DGRW provide in the current landscape?
Well, I'd say you could use it as the blend fund for basically your entire U.S. equity allocation, because what it's done is it's held up throughout the years. And most of the time through those years, we used to call them the FANGs. These days we call them the MAG 7. Most of that time it didn't own very much of those at all and still managed to keep up. And now I think it's becoming very relevant for right here, right now, in that, well, the MAG 7 is generally weak, and it's starting to really show in an ugly tape, in a market that wants to go sideways to down, that it is kind of like the all seasons ETF.
So with being an all seasons ETF, there are rebalances that happen, and it underwent a rebalance in December. So can you tell us a little bit about any notable changes there?
Yeah, you have, well, one of the things that came up, I guess you could say, is Exxon and Chevron started to show up. They were passing the profitability screens, showing up in size, even inside the top 10 in that allocation. So the screens, which are return on equity, return on assets, and subsequent and future earnings growth, starting to identify the U.S. energy patch, and Broadcom starting to fall out of that type of situation. So it's really liking staples, it's liking industrials, energy. Those are some of the sectors that are really recently popping up in that screen.
What are the benefits of diversification in those screens for quality and growth screens?
Well, one of the things is with quality, you can end up theoretically, we don't know what the future may hold, really protecting should the market end up looking to punish junkier names. I think that's the key with the quality screen. But when you do it with earnings growth, put dividends into the concept as well, what you can do is really create some sort of dividend growers type concept through the years. And I think that that's really the appeal of the mandate, is that not so much what is the dividend yield now, but what could you get in cash flows in 2030 or 2035. And I think that's part of the reason it has a ton of success since we launched it back in 2013.
Yeah, that's amazing. Thank you so much. It was great to learn more.
Thank you.